Good morning. Mark Ostwald from ADM Investor Services International. Wanting to share a few thoughts this week about central banks, above all in the context of the fact that we've had the Fed and US Fed and the Bank of England rate meetings this week with rather different outcomes for both. And we also have key rate decisions coming up next week in Australia and New Zealand. But let's start with the Federal Reserve. The Fed made basically a fairly sort of stern effort to lean against market expectations of a rate cut for this year. Thus, we are now looking at December as being a 50% chance of a rate cut this year. And that is in comparison with a 66% chance beforehand. The big risk here is still that the market's pricing in still a 1 in 2 chance of a rate cut, and then the next rate move might actually be higher. Next week's CPI data obviously going to be quite instrumental in that. That's going to be heading back up to 2.1% on both headline and core. And we've obviously heard from Mr. Powell, who's basically been emphasizing that the market really needs to keep a close eye on what's going on with GDP and indeed with what's going on with the unemployment rate. Thus, this week's labour data will be quite important in that respect, but it's unlikely to change the perspective that labour demand remains extraordinarily strong in the United States, and therefore there isn't a case for a rate cut anytime soon. And if we have to reprice Fed rate expectations in a significant way, say we move that from 50% of a chance of a rate a cut by December to say a 25% chance of a rate hike by the Q1 of next year, then that would have big consequences for all markets. I think one can also see that in what we've been seeing with US 10-year yields. We're gradually drifting higher to probably have a retest of the high that we saw in recent months around 260. And that is in part obviously reflective of the fact that we are going to see CPI gradually recovering, and that in turn is predicated by the rise in oil prices, obviously notwithstanding the fact that we've had quite a big sell-off in oil prices this week. Now, by contrast, let's have a look at the Bank of England. The Bank of England's meeting was interesting given that they revised up their GDP forecast for the next 3 years quite sharply, for 2019 to 1.5 from 1.2, to 2020 to 1.6 from 1.5, 2021 2.1 from 1.9. They did, however, revise down their forecast for CPI this year quite sharply, down to 1.7 from 2.4. But they also revised down their expectations for the unemployment rate down to 3.7 from 4.1 at their previous meetings. And did the market take any notice, despite the fact that Mr. Carney was basically trying to lean very, very heavily against the market's current rate trajectory, suggesting that it wasn't discounting enough in the way of tightening policy over the next year, over the next 2 years, given that only one rate hike is actually priced in for the 2-year period, beyond which, particularly given Brexit uncertainties, there's probably not a lot. But markets didn't pay any attention to it, and I think there's 2 reasons for this. First of all, the strong growth that we've seen in Q1 is unlikely to be repeated in Q2, and therefore the Bank of England may be revising down their forecast when we get to the August inflation report meeting. And secondly, the Bank of England's own forecasting record over the past 10 years has been very, very poor. They are very reactive, very rear view, and therefore the forecasts don't really count for much, and therefore the market was, given Brexit uncertainties on top of all of that, probably right to do that. Now, I just want to mention in brief the Australian and Kiwi central banks next week, simply because in Australia the housing market is now proving to be a big problem for private consumption, and therefore the RBA is expected to cut rates by 25 basis points to 1.25, and indeed the RBNZ in New Zealand is expected to cut by 25 basis points to 1.5. Really, what I think the message from all of this is a very simple one. There is quite a lot of rate divergence, and there's going to be quite a lot of rate of divergence volatility coming up, and that it will have its effect, and it will also, if we're in this situation of the Fed basically still be on tightening mode, that the dollar will be underpinned.